All right, so I haven't done one of these in a bit over a week. I had a few gigs on, 4 in a row, which is great, and I really just been letting my positions roll. I'm a macro trader, really, so most of my trades, the ones that work, are a bit of the set and forget ones when I find something that makes sense on a macro level, and then you just let the macroeconomics do the work as they play out. Day trading, intraday punting, sniping, it's a mug's game, right? If that's how you think you're going to make a gazillion, frankly, I think you're deluded, and you should give up now before you blow your account to smithereens. The odds are against you. It doesn't work. People who promise you formulas and systems, that's bullshit, man. They do not work. Macroeconomics, on the other hand, it does. You find, and it's proof in the markets, right? When you look at, for example, hedge funds, you get macro hedge funds. You don't get hedge funds that day trade, right? You just don't. And the reason? Because it doesn't work, right? It really is potluck. So here's a few things from a macro view that I've been looking at for a while. One of them is, obviously the top and how far could it go down, right? That's the fundamental premise, right? So this is 75 to 87, 154 months, 87 to .com, 154 months, GFC to basically beginning of the year, 154 months. The goose has been cooked. I was talking about this end of last year, beginning of this year. That's one. This long-term channel, we've busted through signs of exhaustion with some negative divergence on the monthly RSI. The RSIs, them and the Bollinger Bands, they're the only two indicators that really I pay attention to, the technical indicators, the statistical ones anyway. So overbought, negative divergence, top of a channel that's been going for a long time, up there with the two previous big bull runs. When you look at the Bollinger Bands in here as well, let's put those in for a moment. It's got a long way to go on the Bollies. The Bollies, that's a standard deviation, right? So that's down like 3,200. And when you look at the monthly Bollingers, it comes back, right? In periods of corrections, okay? It comes back to the bottom of those Bollinger Bands, or at least very close to there, right? If it comes back close to here, we are looking definitely sub 4,000. That's 3,500 to 3,200. That's quite a long way to go if it keeps going. So the downside risk is far greater still in my mind than the upside risk. Having said that, I guess the question is, where are we now? I've been short the S&P, but I halved it, and the reason I halved it was this. Strengthening RSI on weakening price action. So I halved it. It was around 4,170 to 4,180. I halved it. I wasn't confident enough in the strength of the market given all the uncertainties that are still out there. Inflation, Fed rising, higher commodity prices, geopolitical situation, extended valuations, the whole thing. There just wasn't enough in there for me to actually scrap, let alone go long. So I'm still short, and this little bounce has taken it hang on, wrong indicator. Let's go to the Fibos. This retracement is roughly a 50%er, right? It's kind of bang on there, right? Still could have still could come back, right? That 4,550, that would not be out of the question. And when you look at it, that line, that is just on there, right? So that's where it could definitely come back to. I still think the main game is going down. This, big run here, or it's not dissimilar to this big run here. Bear markets, you get rather big rallies. As far as a FIBO extension, it still takes it down into this 4,000 realm. Having said that, really, there is a chance that it's going to just hang on to this FIBO here, that first FIBO, instead of going down there. I do think, though, it's only a matter of time before it keeps on going down. So that's the S&P. So I'm still short that, although not as much as I was. I'm still short the bonds, which I'll come to in a moment. That's the Aussie 10s, the Aussie 3s, the US 2 years, and the Bund. And I'm long the Aussie. Let's look at some of the other markets. The one I always find interesting The Russell, again, you can see it's hit an important fibbo, but in terms of my favourite pattern here, I'm going to look at these ones on a weekly. In terms of one of my favourite patterns, it's still rolling over and ready to go. But it has found some healthy support there that still might hold. The Nasdaq, let's look at the Nasdaq. Similar to the S&P in this long-term channel where it's just rolled over from the top. It has hit a fibber. Let me get rid of some of these things. Take that out there. So it's hit the 38 fibbo rather than the 23. It still could go further, to state the obvious. To me, this is still a bear market rally. It's a 38 retracement. So if I get rid of that, it's a 38 retracement that it has come back to, like on the knocker, and it is sitting between that, this level down here around just 13,000 and 14,500 at the moment. As far as where it could go to, looks at that. That's some pretty ugly fibbos there, right? Let's have a look at it. Put a 618 in there, see if that looks any healthier. Look at that on a technical reading. That level looks pretty compelling to me on a technical read. That's 12,000. Where does that fit with the overall fibbo? Yeah, not far off the 50%. Okay, so that's the Nasdaq. Still looks bearish to me. Certainly hasn't broken the downward trend yet. The Dow, you can see there that trend is still very solidly intact. So on the S&P, we can see that this move broke the downtrend. On the Dow, it's a different story. It's still very convincing downtrend there. Hasn't become overbought on the dailies. On the 4 hourlies, getting up there, right? Okay, so to me, top of the downward trend, 4 hourly RSI overbought, it's a sell. That's my signal on that, and that's why I'm not going to cut my positions just yet. So they're the equity markets. Let's look at the bond markets. So the US 2 years, I've been short them for months, and we're going to look at these on a weekly. As I said, I'm a macro guy, right? And really, when it comes to macro things, the bonds they're the best thing for macro trading because they are genuinely forward-looking. Like a 2-year bond, a 5-year bond, a 10-year bond, they are by definition forward-looking. The volatility in the equities is obviously much higher, and sometimes equity traders just don't pay attention to what's going on in the bond markets. So we can see here, it's certainly filled that gap. As I said, I've been short since like October last year, September, October, which was down here. Been a really easy trade to ride, so you just roll it, and I'm going to keep on rolling it. It's still got a little bit of way to go, even before it gets onto that this downward trend line that's been going on for years. This is going back to 1990. And really, 3% to me looks like a better target. I think it's going to bust this, given that we are just at the start of the cycle. But a lot of it is already priced in here. I do think it could go a little bit further. Certainly not a time, I would think, to be getting onto this trade. To me, not a time to be getting out of it either. Probably getting to the stage where I might look at trimming it, dare I say. That's the 2 years. The 10 years, they've still got a bit of a way to go. And when people talk about the curve flattening, the trade to look at now is the one I call the whooshka, right? And that's the one where the steepener of the 10 years to the 2 years, or even shorter, the 10 years to the 3 months, which is a bit harder putting on because of the roll risk, just rolling through those short 3-year Eurobond futures. But the curve is obviously flattening. I think it's like 20 points or something like that at the moment. A lot of people getting excited about that. I'm a bit of a looker, whatever. I've been short all these bonds. To me now, I'm turning around saying, right, I think the long end could take off. That's the one that I'm looking for as the curve looks to steepen as these rate rises come in. You can see, similar to the twos, it's broken this trend on this Fibo extension. It takes it beautifully to this 3.18 level, which is kind of right near that long-term inflation target. That's got a bit more to go, and I think once the curve flattens, it's going to be probably a tiny little bit more. It's going to be time to put on a pretty aggressive 10-year, 2-year steepener. That's the next macro thing that I've got in mind. So that's the bonds, the 2s and the 10s. I won't bore you with the Aussie 3s or 10s. Looks at the Aussie dollar. The next one, the Aussie Deliro. I love the little Aussie Deliro. It really does trade very nice on some technicals. This is back when it was par. Got a really nice 1, 2, 3, 4, 5 for the Elliott wavers out there. As I said, I'm not a big subscriber to Elliott wave theory. Sometimes you can see really nicely in hindsight how it goes. I've never ever met an Elliott wave technician who actually trades and makes reliable money. And the evidence is you don't get any hedge funds out there saying I'm an Elliott wave trading hedge fund. Hedge fund, do you know why? Because it's all bullshit, right? It looks good in hindsight. You can make up some beautiful rationales for what happened. You can come up with some really nice justifications of what you think's going to happen, but it doesn't work. In the trading room, there used to be a guy who did these daily and weekly technical reports on his Elliott waves. We gave him a trading book to run one time. It was a disaster. Absolute disaster. So, but despite that, this did be a really nice, a 1.6 to 1 wave relationship down here, 1, 2, 3, came back up here, did a nice 1-to-1 right to the ding dong there, and it was really the ding dong. Let me get it going, the candles here. You can see it just coming in there, and to me that looks like on the way back, right? I am hoping that it's going to do the same thing. The way commodity prices are at the moment, and if this thing with Russia drags on, Australia is a massive beneficiary through gas, coal, wheat and gold, where Russia, China and Australia are the 3 biggest gold producers in the world. Indonesia and Australia are the biggest coal producers in the world, and then I think comes Russia. Australia's a massive wheat producer, it's number 5 or 6. Gas, Australia's like one of the 6th largest LNG exporters. So these are all big markets that are going to be affected by sanctions on Russia. Australia's in for some absolutely stunning GDP numbers in coming years. There's a little double bottom here, right on that 70 cent mark, and to me that is going to spell that is to me a very good place for it to hit the bottom of this channel that's been going on, right? And you can see how it is busted through there. So I'm bullish on the Aussie. This is definitely going to be a buy the dip scenario. I think it's going back definitely to this 80 cent level. There's no reason for it to break 70. So the downside, 4 cents to make 8 cents on the upside, 82 cents, something like that, possibly more. Pretty compelling. That's the Aussie dollar. When I look at gold, I'm a skeptic on gold. Really, it was a flight to safety, but to me that's kind of over. What's going on here is exactly the same as was what went on here, where it had a big run up, had a consolidation, dived down, and really you can see here how it dove down. That was a 1-to-1, from that basically 1900 to 1560 down there to 1222. That kind of move there. That's just that Fibo extension there. If we did another Fibo extension just on the size of this range, it takes down to 1300-ish, which is that previous breakout level. So again, that's one of my favourite little patterns of a big run up, a consolidation, turns over. And just as there's a neckline here, neckline there, some descending highs here, descending highs, a bit of a last ditch spike, a bit of a last ditch spike. To me, I'm not convinced that gold is going to hit new highs, even if the shit hits the fan in Russia and Ukraine. And the reason for that is, let's face it, the commodity to play that situation is oil. Speaking of that, I've long Australia's largest oil and gas producer, Woodside. That's been going great at little trades. Their shares have gone from $23 as high as $35. I sold some puts on those back in September. Picked up like $1.50 on those, so there's $1.50 on that plus another $10 or so on the price. Did about 10,000 of those shares and options, so that's been a really nice little earner. Playing oil is difficult because of the contract rolls. If you don't understand the contract rolls and the futures, then you shouldn't be doing it. If you're doing it on CFDs, I think you're nuts because the volatility in oil will take you out. Oil to me is much more easily traded through the equities rather than the futures. Look, that's pretty much it for the equity markets, the bond markets, the currency and gold. As I said, I'm still short this. The strength has never ceased to surprise me in this market for this whole run. There are a whole lot of indicators to me why it's been the end, whether it's the 154 months, whether it's the monthly Bollinger Bands, whether it's this big long-term channel, which it's right at the top of, that it's breaking down through the top of. There's the stretch valuations, the break of obviously that trend line, which has been a clear break, the monthly engulfing bearish candles. You can see them. They don't happen very often. There's one there back in September, which I was ringing alarm bells about, and there's another big one obviously in January. To me, there's a whole lot of reasons why this market could go lower, not a lot for it to go higher. In fact, the only reason for it to go higher is so many people are pessimistic, right? And people have gone long cash, and that's what gives rise to the bear market rallies, which is what I suspect we have seen. As I said, this break here, to me, it is a significant break, but it's certainly not a game over for the bears. Those like me who are sceptical, but it still could certainly go to 45.50 before either consolidating this range or having another retest down here. A bit of sideways consolidation to me looks a bit more likely, but it is vulnerable. Anyway, look, that's about it. Have a good one.